Welcome to another session of the My Solo 401k Financial My Community Daily Webinar Series. If you have questions or topics you wish to discuss, please chat those over. We do want to spend some time with some prepared content, specifically comparing the solo 401k versus a SEP IRA. So we're definitely going to get into that. But first, with the housekeeping. So the presentation is always being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor is a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. You can always find us in our community, mysolo401k.net/mycommunity. It's always free to join. All are welcome. You can post questions there 24/7. You can check out our video library of videos and webinars. There's a lot of great ways to learn and to share the knowledge. If you're on YouTube, please subscribe if you're on YouTube. Then you get notifications of all the webinars. We go live twice a day. We have live Q&A sessions. Once at 10 a.m. Pacific, 1 p.m. Eastern. And then we're back again at 1 p.m. Pacific, 4 p.m. Eastern. You can also find the schedule at mysolo401k.net/webinar. For example, tomorrow in the morning session, we're going to talk about Roth solo 401k versus traditional solo 401k. In the afternoon session, we're going to have a deep dive discussion around all the contribution rules and considerations, specifically for businesses taxed as a sole proprietorship, or it could be a single member LLC taxed as a sole proprietorship. Those would be for 2024 and 2025. So if you like and subscribe, you get all the notifications, et cetera, et cetera. So with that in mind, let's take some time to discuss solo 401k versus SEP IRA. Some of the key features and considerations. So both the solo 401k and the SEP IRA is a retirement plan that's available to self-employed individuals. So in order to set up a solo 401k, you need to be self-employed with no full-time W-2 employees working for you, right? No non-owner, non-spouse, full-time W-2 employees. So of course, the self-employed person or their spouse can be an employee, but you can't have other people that are non-owner, non-spouse people that are working on a full-time basis. So as long as the individual is self-employed with no full-time W-2 employees, they'd be eligible to set up a solo 401k. So that would give them access to those features of a solo 401k that are not available to a SEP IRA. So I want to spend some time talking about some of those key features. So number one is the mega backdoor Roth. So yes, with Secure Act 2.0, Roth contributions can now be made to a SEP IRA, but there's still going to be employer contributions. So there's definitely some limitations there. Limitations, for example, in terms of how much you can contribute. So when you make employer contributions to a SEP IRA, it's a percentage of your self-employment compensation. For example, if your business is taxed as an S corporation, it's limited to 25% of your W-2 wages from your S corporation. So if you want to contribute $20,000, you got to have $80,000 of W-2 wages, right? And so let's say your business is an S corp. Well, you might have set up that S corp to minimize self-employment tax. So that in a way, there's a tension between the objective of the S corp, or at least part of the objective, which might be to minimize self-employment tax, and be able to maximize contributions to the SEP IRA, because the more that you decrease your W-2 wages, the less that you can contribute, because again, it's a percentage. So whereas with the solo 401k, you've got other buckets that you can contribute to. Just like the SEP IRA, you have the employer bucket, but with the solo 401k, you have the employee bucket plus the voluntary after-tax bucket. So with those two additional buckets, you are able to hit the maximum contribution limit with a lot less income, because you can contribute 100% of your compensation, dollar for dollar, all the way up to the overall limit as a Roth or a mega backdoor Roth contribution. So take, for example, someone who's under 50 years of age, they're trying to make contributions for 2025. They would only need $70,000 of W-2 wages from their S corporation to be able to make $70,000 of contributions as a Roth and or mega backdoor Roth contribution and end up with $70,000 in their Roth solo 401k account. So with a lot less income, you're able to hit the maximum contribution amount. So you can still, so folks will say, well, I can still meet my S corporation objective of minimizing my self-employment tax, but still maximize the funds that end up in a Roth 401k. So that's a huge advantage because you got those two additional buckets, the employee bucket and the voluntary after-tax bucket, available under a solo 401k plan like our plan that's not available through a SEP IRA. Key feature number 2 is the loan option. So you cannot take a loan from any type of IRA, whether it's a traditional IRA, a Roth IRA, or a SEP IRA. You just can't do it. Whereas with a solo 401k plan like our plan that includes the loan feature, the solo 401k participant can access those solo 401k funds for any purpose whatsoever. It could be an emergency purpose, or it doesn't have to be an emergency. It could be other purposes. And if it's structured as a loan, paid back according to the loan terms, that is not going to be subject to taxes or penalties. They got penalty and tax-free access to funds via a solo 401k loan. So number 1, the loan documentation requirement. We handle the loan documentation requirement as part of our service for no additional charge. We prepare the loan documents within 1 business day when clients request it. Number 2, the loan repayment requirements. So the loan has to be paid back in either monthly or quarterly payments, equal payments of principal and interest. The interest is prime plus 1%, or it could be a CD rate plus 2% with those payments spread over a 5-year term. The amount of the loan is going to be limited to 50% of the balance, not to exceed $50,000. Third key feature, alternative investments. So with our solo 401k plan, our solo 401k clients can really invest in what they want because they're able to invest in a wide range of investments. Traditional brokerage type investments could be mutual funds, ETFs, stocks, bonds, etc., certificates of deposit, as well as true alternative investments like real estate, Bitcoin, private placements, private stocks, precious metals, all with checkbook control. So in order to be able to invest in alternative investments through a SEP IRA with checkbook control, number 1, the SEP IRA account holder would have to have a SEP IRA account at one of these specialty IRA companies or trust companies or financial institutions that allows for alternative investments. And then if they want to have checkbook control, that would require setting up an LLC underneath their SEP IRA, where the IRA, the member of the IRA is the member of the LLC is their SEP IRA, and then the individual is the manager. Whereas with the solo 401k, the self-employed person is the trustee of the solo 401k and has direct checkbook access. No need to have an LLC. No need to have the account at one of these specialty trust companies. As a matter of fact, we help our customers open up accounts at the bank or brokerage of choice. We've helped our customers open up accounts at hundreds of different banks, many different brokerages. Next key feature difference when we're comparing solo 401ks and SEP IRAs is the $1,500 auto contribution tax credit. So setting up our plan will make the self-employed business eligible to claim $1,500 in solo 401k tax credits, $500 per year for 3 consecutive years. So if you set it up here in 2025, the self-employed business will be able to start claiming those $500 tax credits when they file the 2025 tax return, and then again for 2 more years. This tax credit is not available to a SEP IRA, the auto enrollment tax credit. Now, It's a tax credit, not a tax deduction. So that means it's a dollar for dollar reduction in the tax liability. It does set a default 3% contribution amount, but the solo 401k owner, the self-employed individual, has the right to opt out of that default amount. So opting out doesn't mean that they're not eligible to claim the credit. What it means is now they can make contributions in whichever amount or schedule they prefer. Employee deferrals. So that goes to the mega backdoor Roth conversation where I described how with the solo 401k, there's additional types of contributions that can be made. One of those are employee deferrals. So employee deferrals are not available under a SEP IRA. With a SEP IRA, you can only make the employer contribution, which again is a percentage, whereas the employee contribution limit is 100% of compensation, dollar for dollar, up to the applicable limit. And then those contributions can be made as pre-tax or Roth, etc. Easier to make contribution, to maximize contributions, So that again goes to the fact that with the solo 401k, you can make the employee contribution, you can make the voluntary after-tax contribution. Both of those contribution types, the limit is 100% dollar for dollar of the self-employment compensation. So you don't need as much self-employment income to justify the contribution. Whereas with the SEP IRA, it's a percentage of the self-employment compensation because that contribution is made as an employer contribution. All right, well, hopefully that sheds light on some of those key differences between a solo 401k and a SEP IRA. We appreciate the chance to discuss that. All right, so now we want to go to the good questions. Thank you so much for taking the time to participate. As mentioned, please like and subscribe on our YouTube. We go live twice a day, once at 10 a.m. Pacific, and again, 10 a.m. Pacific, 1 p.m. Eastern, and then we're back again in the afternoon at 1 p.m. Pacific, 4 p.m. Eastern, every day, Monday to Friday. It's always a live Q&A, so you can bring questions. You can hear what other folks are asking about. If you subscribe, you get the notifications. We oftentimes have prepared content. Like today, we spent some time on the solo 401k versus the SEP IRA. Tomorrow, we'll be back in the morning to discuss Roth versus traditional 401k to understand the key differences there. Then in the afternoon, we'll talk about contributions A to Z with a specific focus on businesses that are taxed as a sole proprietorship. So we're always looking to discuss these topics and try to help people learn and focus on education. But we also want to discuss the questions that you have. So we appreciate the chance to do that. First question, is it correct that contributions by employer to fund the brokerage accounts need to occur by the tax return deadline? What is the deadline for employee contributions into brokerage accounts? That's a great question. So what's interesting is that a lot of individuals' experience with the 401k comes from the corporate world, where, for example, the employee contribution deadline is the end of the year. The deadlines are different, though, for self-employed individuals. And from a policy perspective, that makes sense because one's ability to contribute to the plan is based on their self-employment income, right? You can't save more than you earn. And a lot of times folks don't know exactly how much they've made until after the end of the year, right? They might have a seasonal business where they're earning a lot of their income all the way up until the end of the year. And so once the dust settles, then they can determine, okay, exactly how much they're going to report. And then from there, how much they're eligible to contribute, et cetera. Now, for a plan that was established by the end of last year, so if someone signed up with us that would have established the plan, they would have preserved the ability to make all types of contributions for 2024, whether employee, employer, or voluntary after tax, by the business tax return deadline, including extension. So for example, if their business is taxed as an S corporation, that deadline is March 17th or September 15th of this year. If their business is taxed as a sole proprietorship, where they're reporting their earned self-employment income on their 1040, well, that means effectively their business tax return deadline is the 1040 deadline. So it's April 15th, or if they file timely extension, October 15th. So again, if someone signed up on or before the end of last year, they would have preserved the ability to make all types of contributions for 2024 by the business tax return deadline, including extension. All right. I'm self-employed, and if I have two separate companies, one with 5 full-time employees and one without employees, just me and a spouse, would it be possible to claim the auto contribution credit on my solo 401k and also claim the 401k startup tax credit and $500 auto contribution credit? No, one business or group of businesses cannot, they can only claim the auto contribution credit once. Now, there's also a question whether or not that business would even be eligible to set up a solo 401k, because typically, if you have one business with employees and another business without employees, and they're both owned by the same person or group of people, like say a husband and wife, then under the control group rules, the employees working for one business are going to prevent the employees, or they're going to prevent a solo 401k from being set up for the other business. But putting aside that control group issue, again, just to answer the question, if you look at the auto contribution credit rules, only one credit can be claimed per control group. Now, it is possible to share. So it's possible, for example, for maybe $250 of the credit to be claimed by one entity and $250 by the other, for example. But in sum, it's got to be $500 across the whole group. Good question. Thank you for bringing it. Can you please clarify how Roth employer contributions affect income on an LLC taxed as a partnership? It's confusing as to what and how it gets reported on a 1065, K1, or 1040 and the timing differences. Great question. So with Secure Act 2.0, the ability to make employer contributions as Roth contributions was enabled. Now, in our experience, based on our client feedback, it really was not taken advantage of. Why? Because our plans already allowed for mega backdoor Roth contributions. And as I mentioned, if you're making employer contributions, whether it's pre-tax or Roth, it's going to be made as a percentage of that self-employment income. So the individual is going to need a multiple of the amount that they want to contribute as earned self-employment income. Whereas if someone's trying to make voluntary after-tax contributions, they're able to contribute 100% of the voluntary after-tax contribution dollar for dollar up to the overall limit, assuming they don't make any other contributions to the plan. So you don't need as much money to be able to maximize that contribution. Other reasons would be simplified reporting. A third reason would, and we'll come back to the reporting because that'll go right to your question. And then a third reason would be more flexibility with those voluntary after-tax contributions. For example, if someone has a plan like our plan that allows for voluntary after-tax contributions, as well as an in-plan conversion or a transfer out of those voluntary after-tax funds, they're able to make the voluntary after-tax solo 401k contribution. And then if they choose to, transfer those voluntary after-tax funds out of the solo 401k to a Roth IRA. Whereas if somebody makes an employer contribution to their Roth account and then later wants to transfer the funds out of the Roth solo 401k to a Roth IRA, they would have to meet a triggering event, right? So you're still going to be subject to those distribution rules. Whereas one of the exceptions to the distribution rules is voluntary after-tax funds. So the voluntary after-tax funds can be transferred out right away to a Roth IRA without a need to meet a triggering event. Now, back to the reporting. So there was a question for almost a year as far as, I'm talking about after Secure Act was enacted and enabled employer contributions to be made as Roth contributions. There was an open question as far as how to report those employer contributions made as Roth contributions. Because historically, before that, employer contributions were always made as pre-tax contributions. In other words, they reduced the employer's taxable income. But with Secure Act 2.0 now allowing for employer contributions to be made as Roth contributions, it was a question, okay, well, how do I report it, right? So ultimately, the IRS answered that question almost a year later after the law was enacted via IRS Notice 2024-2, where they clarified that the employer contribution, whether it's made as pre-tax or Roth, has to be reported as tax deductible on the employer's return for the year of the contribution. And then it's going to be reported as taxable because it still has to ultimately be taxable, right? Because it's a Roth contribution. It's going to need to be reported as taxable to the employee for the year of the deposit. So this brings in our prior discussion about deadlines, right? How for a solo 401k, contributions can be made all the way up until the business tax return deadline, including extension. So that'll results in many people, for example, making contributions for the prior year. For example, individuals making contributions now here in 2025 for 2024. So if an employer contribution is made for 2024 as a Roth contribution, that employer contribution will reduce the taxable income on the employer return for 2024, but then it'll raise it on the employee's return for the year of the deposit via 1099-R for 2025 for the year of the deposit. So in the case of a business that's taxed as a partnership, that employer contribution, whether it's made as a pre-tax or a Roth, is reported on line 16 of Schedule 1 of the 1040, as well as line 13 of the K1 using code R. And then it'll be reported as taxable to the employee for the year of the deposit via 1099-R. So for example, if it's deposited in 2025 for 2024, it reduces that 2024 employer taxable income, but then raises the 2025 employee taxable income. Thank you for the good question. Regarding the first question, wouldn't the employee contributions be required by January 31st when the W-2s are to be filed? No. Per IRS, great question. So it could be reported, of course, on the W-2, but it just needs to be deposited by the business tax return deadline, including extension. This is per IRS publication 560. There's a chart on page 3 that makes it crystal clear that as long as the plan was established by the end of the year, for example, December 31st, 2024, that preserves the ability to make all types of contributions, including employee contributions, by that business tax return deadline, including extension. So it can still be reported on the W-2, but it doesn't have to actually be deposited till March 17th or September 15th in the case of an S Corp, where an extension is filed, a timely extension is filed for that S Corp return. It gets reported on Schedule 1 of the 1040 and then line 13 of the K1. Here is slides specifically for a partnership. You can look at slide 40 of 54. Share that with your tax advisor. We provide that for educational purposes, of course. And that's the type of content that we're going through now is this contribution season. We just did the S Corporation deep dive discussion last Friday. Tomorrow, we'll be back in the afternoon session to do the same deep dive discussion for sole props. And then the plan would be next week to do it for partnerships. And then we're going to be back with a lot more content. For example, talking about mega backdoor Roth. We're going to talk about the magic number. In other words, how much income one would need to be able to maximize contributions for the business, different business types. So all you got to do is subscribe, hit the notifications button on YouTube, and you get all the notifications. It's totally free content here. But we do appreciate the opportunity to discuss these topics. Yes, let me go to our YouTube channel, and we can pull it up here. 1 second, please. All right, here's our YouTube channel. And you can see, for example, this is the one that's for tomorrow for soul props. You just scroll over here, actually videos, and then we'll go live videos. Click on live, and then you can see, for example, here it is, streamed 5 days ago. So you can see the content we're having. I mean, this is all the content we've done just in the past 5 days. Let me grab this, copy link. And then we've got a page on our website with an infograph and a lot of other good content for S Corps. We've also got it posted there. Let me grab you the S Corp page. Awesome. Well, we appreciate the chance to discuss these topics. Please continue to engage. You can participate 24/7 in our forums. You can come to our webinars twice a day. You can find the schedule at mysolo401k.net/webinar, or just subscribe on YouTube to get the notifications. So thank you so much, everyone. Appreciate the good discussion. Until next time.